It is a pleasure to welcome our industry expert Ms. Amrita today. Ma'am, what is the psychology behind an investor making the same mistake again and again?
Somewhere maybe around 2004, if my memory is serving me correct, two gentlemen won Nobel Prize in economics. One was Robert Schiller, the other was Eugene Fama. Robert Schiller is a proponent, is an encourager of behavioral finance. And Eugene Fama is a proponent. He backs traditional finance. He backs all your efficient market hypothesis. So Eugene Fama backs passive management. Robert Schiller says that behavioral finance persists. Now, the same Eugene Fama, a year later, when there was too much of bubble and speculative market activity in US, made a statement that prices have become irrational. Can you believe that somebody who speaks about efficient market hypothesis also made a statement that prices are irrational? So the tenet of behavioral finance is that in reality, markets are neither efficient nor completely anomalous. That is, not completely distorted. They are neither super efficient, neither anomalous. They lie in between. Second is, human rationality rarely manifests in black or white absolutes. We are rational sometimes, we are dumb sometimes. We have to agree to it. It is better modeled across a spectrum of gray. Now, if you understand that, you will appreciate it. And believe me, a lot of our success in wealth creation will happen if we know a lot about biases. Knowing about biases is half the battle won towards our journey of creating wealth and keeping ourselves financially secure. So we will now get into, after understanding system one, system two thinking, the differentiation between traditional finance and behavioral finance. Let's look at what are the behavioral biases. But before that, behavioral biases can be branched out as cognitive and emotional. What is cognitive? Cognitive is the failure to think clearly. It is consuming the data in a very, very myopic manner. You are giving a lot of attention to the information that is supporting your belief and disregarding information that is not supporting your belief. Many a times it happens that we have a favorite product, we have a favorite stock. We will only give attention to all the positive news about that stock. But if there is something red flags being indicated, we ignore that. That means we are giving selective attention, and that's called a cognitive bias. Or we are buying or investing into products which are heavily advertised. That means something that is top of the mind recall, which is lodged easily in our memory, that is influencing us to buy. Typical classic system one thinking, and that is a cognitive error. Sometimes the way knowledge is presented to you. Let me ask you a question. Which paneer will you buy, or which cottage cheese will you buy? 99% fat free or 1% fat? Which is the cottage cheese you're going to buy? 99% fat free or 1% fat? What will be your response? So both are the same. If you look at this, can you sell a product which says 1% fat? Nobody will buy it. Or you can see the Diet Coke strategy, 99% sugar free. Imagine Coke comes out with a product which says 1% sugar. That 1% sugar will make people think they'll get diabetes, or that 1% fat will make people think that they'll become obese. So this is something marketeers have always exploited to show, position a product saying that it is 99% fat free, 99% sugar free. And that is why it entices a lot of us towards such kind of products. Now, that's called knowledge representation, and that's called framing bias. The way information is framed, that is why whenever you have attended annual general meetings, shareholder meetings, you would have seen that the founder starts with all the positive news first, because he wants to frame your mind towards thinking positively about the company and not negatively about the company. So cognitive biases is basically the way we consume information. It leads to faulty reasoning, but with knowledge, awareness, hand-holding, this can be reduced because it is a statistical consumption error. We are not looking at the data in a proper fashion. We are looking at it in a very, very distorted fashion. But if we are given proper education around it, cognitive biases can be reduced. And the examples of cognitive biases are confirmation bias, representative bias, availability bias, framing bias, hindsight bias, anchoring bias.
Thanks for your detailed explanation. Are you in search of a personal guide who can remove the stress of handling your finances? Then please feel free to avail our expert consultation. And also, you can attend our webinars to gain investment related insights. Both the consultation and webinar are absolutely free, and you can find the link in the below description. Please like and share, and do subscribe to Holistic Investment.